Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The story of this market had been the story of three channels, though it's continuing to change. Originally it was the mid-June to early September shallow bear channel, held up in late August at the important 38.2% absolute Fibonacci support below at 521. Now please remember that level as it may become important in the future. This ignited the bullish incentive enough to push up and out of the bear channel. The subsequent early September to mid-October bull channel that peaked with a V-top type formation in early to mid-October. And the most recent example, a dark blue highlighted mid-September to date bear channel that has been finessed a little and which I'd acknowledge looks like it was possibly morphing into a descending expanding wedge pattern, especially with prices forming an extension to the V-top over the end of October and start of November. I said these things were changing, and so they have, as prices have sauntered sideways out of this bear channel along the very shallowy bearish bright red neckline currently at 558 of the February to April reverse head and shoulders bottom. This sideways sauntering has stopped yesterday and today as prices have started to run along the top side of the dark blue broken bear channel, which is currently at 540, as well as testing previous support at 545 from March and August and at the September 2020 low at 540. I've suspected for a few weeks now that the 38.2% absolute Fibonacci line at 521 might also be influencing this as well. Meanwhile overhead, for a second week the December 2020 low at 566 has capped prices, though I'd also keep an eye on the fairly flatlining medium moving average overhead, and that's currently at 576 as a resistance, as well as further up the declining short medium moving average, currently 577, and the flatlining long moving average, currently 589. There is also the spectre of this week becoming a weekly key reversal, if only just. If we close tonight either over 558 or under 551, then we're beyond. Right now we are very much looking at a possible weekly key reversal down, and that's something to bear in mind. In the bigger picture, I said last week, and I quote, what I suspect may be taking over the running here of this market for at least a little while now, and arguably has done so since early October, is a pattern I drew last week. It's 2 weeks now. A late May to early October bearish shift pitchfork. The market right now is in between the overhead upper time, currently at 577, and the middle time below, currently at 540, end of quote. Now watch this space, specifically about that bearish shift pitchfork and the weekly key reversal. That's something to definitely watch out for. Chicago corn. The green short medium moving average, currently at 435, had previously showed a significant support to this market back in mid-October, halting a decline, and started after initially being capped at the gold long moving average, currently at 433, and conversely also being held up and helped higher by the 50% absolute Fibonacci at 425. Started a mid-October to end November bull channel. 6 weeks ago I asked the following question, and I quote, the key question will be whether prices can attain the early October highs between 450 to 455, or will the erosion of the bullish incentive by, for example, the gold long moving average, or the November 2020 high at 439, whether this will be enough to prevent prices from trading higher, end of quote. Well, the 450 to 455 area topside has indeed capped the topside. once during November without even being tested, and prices did for a while a staircase dance of 2 steps down, 1 step up, etc. In the more recent times, the last 3 weeks, specifically the green short medium moving average and the gold long moving average have become supportive, but not to the level of earlier efforts, as prices did end up exiting the bull channel on the downside 4 weeks ago. Though truth be told, the 2 moving averages and the 50% absolute Fibonacci line at 425 did turn prices back higher, enough that last week and this, the market challenged the broken bull channel, but from the underside, though not very effectively, with the middle of last week seeing a 3-day bearish evening doji star pattern, as well as in the middle of that pattern a shooting star pattern, a type 1 bearish, plus what could be seen as a possible gravestone doji, enough that last week it looked like the market may have peaked. However, we had a changing gap higher at the start of this week, with prices moving up and away from the November 2020 high and the 2 moving averages. And I'll now refer you to my words from 4 weeks ago when I said, and I quote, "I fully expect to see further pressure on the downside and even the development of an early October to date bearish flag halfway hesitation pattern, but nothing like this has happened. True, we are below the recent lower bull channel line, seemingly trailing along the underside of it, but we are still above the gold long moving average, which only had the single close below it, and well over the green short medium moving average and the 50% absolute Fibonacci line as well. To me, this means that the recent bull channel is not the dominant pattern here, and another pattern is developing in the next few days, and I'll have to finesse this pattern or retire it completely. All very interesting." End of quote. 2 weeks ago, I thought it might be the mid-May to early October bearish shift pitchfork, but it wasn't. And last week, I looked at the ideas of the October to date action being a possible triple top or even an ascending triangle. Well, this week I still haven't drawn these in, not yet, but I am still thinking about them. One thing I still know is that the 450 to 455 area topside is a crucial area, and we're testing through it at the moment, well, up in between the 450-55 area right at this moment. Kansas City wheat. Much like Chicago wheat, this market has been a story of 3 channels. The oldest and arguably the longest was the late June to early September shallow bear channel that eventually ended up with a spike down flattened V bottom at the end of August. Secondly, there was the late August to mid-October bull channel that was eroded by both the slow declining long moving average, currently 597, and medium moving average, currently 577, as well as the interesting 38.2% Fibonacci line of the big old 2011-2019 move at 618. Finally, the most recent, and the one that was active until 2 weeks ago, was the dark blue highlighted early October, early December bear channel. We also have just above the market the bright red lower trendline extension, currently at 574, the big old November 23 to April 24 descending triangle that was support and is now resistance, possibly some principal resistance as well. Interestingly, the extension itself was due to a pattern I spoke about 12 weeks ago, when I said, and I quote, "During February through to April, we saw the development of a rectangle pattern based on the 551 to 590 area. Please remember this area as it became relevant to more recent action." End of quote. This area was the origin of the original larger bear channel. Anyway, we are below the bright red trendline extension, but above the dark blue broken bear channel. I had previously said 6 weeks ago, and I quote, "All this it also still leaves 2 potential targets below, the primary target X at 531 and the secondary target harder to reach target X1 down at 527. These are targets for the break below the middle bull channel, the late August to mid-October bull channel." End of quote. The market has had trouble stabilizing below this 551 to 590 congestion from the rectangle pattern, though we came very close 2 weeks ago with a low at 535, close to both target X and target X1. Last week I suspected the moment for these targets may have been over, and though I said I would keep them on for another week, I was not too confident in keeping them, especially when you bear in mind that they are at the 38.2% absolute Fibonacci line at 533, the late August low at 527, which would no doubt interfere with any moves lower. However, this past week has softened that stance, as with the capping of the market at the start of this week by the bright red trendline extension and the subsequent move lower for the rest of this week, we are set up here for a weekly key reversal down. Thus, if we close tonight either over 557 or under 553, then we'd be on. Anything in between and we'll have a lesser outside week pattern. Right now we are looking at we're set up here for a weekly key reversal down. Thus, if we for this week, so that's one thing to bear in mind. Now, one final feature was that that was a 2-week-old late May to early October bearish shift pitch highlighted in purple on my daily chart. This week prices pierced but have so far not managed to break the purple upper time, currently at 563. Now, I'm still not sure about this bearish pitchfork, but for now it's still valid, it's still a genuine one, though I'd keep a close eye on it in case it fails. Because if it fails, then there is no fallback, it will simply be retired and I'll have to cast my eye to see what other new patterns may emerge. Now, I mentioned last week that I had an idea of a new pattern, but back then it was way too early to say as yet, and I'm afraid that nothing has changed on this front. So in the meantime, I'll keep a close eye on what happens should we form a weekly key reversal down this week, a possibility I've seen repeated in some other grain markets as well. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Toftbeek and ADM Investor Service International Limited. And here comes the final important bit.